Hi there. Business property relief can reduce inheritance tax. In this video, we explain what the $2.5 million cap could mean.
If you're a UK business owner, listen up. A huge change is coming in 2026 that could seriously affect the legacy you're planning to leave. We're talking about business property relief, and believe me, the rulebook is being completely rewritten. In this explainer from Pro Tax Accountant, we're going to break down exactly what this means for you.
You know, for decades, if you've built a business, you've probably worked under one massive assumption, that its value is safe and can be passed on. Well, that assumption is about to be put to the test. The financial safety net that's protected family businesses for years is being totally redesigned, and being unprepared could have a very real and very expensive impact on your plans.
So to make sense of all this, here's what we're going to cover. We'll start with the basics of the BPR safety net as it is now. Then we'll get into the nitty-gritty of what's changing in 2026. We'll crunch some numbers to see the real financial hit, look at a pretty serious warning for investors in AIM shares, and then, most importantly, we'll finish with a strategic action plan. Let's get right into it. Okay, first things first, let's establish what we're even talking about. What is this safety net that's been so vital for so many years? Well, business property relief, or BPR for short, was created for one key reason: to stop the next generation from being forced to sell off parts of a family business, or even the whole thing, just to pay a massive inheritance tax bill. For almost 50 years, it's been the absolute cornerstone of succession planning. And for most businesses that qualify, that relief has always been unlimited. Well, until now. And that brings us right to the heart of this explainer. The whole era of unlimited relief is coming to an end. From April 2026, we're all stepping into a new reality, one with a hard cap and, yep, new complexities to figure out. Now, these rules didn't just appear out of thin air. The policy actually evolved quite a bit. It all kicked off with a pretty alarming proposal of just a £1 million cap. Ouch. After a lot of pushback, a key concession was made to let the cap be transferred between spouses. Then, finally, the government more than doubled that initial figure to the $2.5 million we have today, which all becomes law in April 2026. This backstory is important because it shows the final rules are a result of some serious negotiation. So let's compare the old world to the new one. Before, it was dead simple: unlimited, 100% relief. Now, we've got three really big changes to get our heads around. First, there's that £2.5 million cap for the full 100% relief. Second, for any value above that cap, the relief drops all the way down to 50%. And third, any unused allowance can be passed to a spouse, and that is a vital planning point for couples. Theory is one thing, right? But what does this actually mean in pounds and pence? Let's have a look at how this can create a very real tax bill for a pretty typical family business. Let's take a relatable example: a successful family-run business valued at £5 million. You know, under the old system, the succession plan was a breeze. 100% BPR meant the business could pass to the kids with a zero inheritance tax bill. A nice, clean, simple transfer. But from April 2026, the picture changes completely. That exact same £5 million business could now be facing an inheritance tax bill of £500,000. This isn't just a minor tweak. It's a massive shift that creates a need for serious cash where none was needed before. So how on earth do we get to that number? Let's break it down. The first $2.5 million of the business value, that's covered by the new allowance. It gets 100% relief, so the taxable amount is zero. Simple. But the remaining $2.5 million, that only gets 50% relief. That means half of that value, so $1.25 million, is suddenly exposed to inheritance tax. At the standard 40% rate, the tax due is exactly £500,000. The crucial takeaway here is that any value above the cap now faces an effective tax rate of 20%. Now, you might be asking, why would the government do this? Well, here's a fascinating statistic from HMRC. It shows that just 158 estates accounted for over £500 million in tax relief. This data really helps explain the government's thinking here. They wanted to target what they saw as a relief that was disproportionately helping the absolute largest estates, and that led directly to this new cap. Okay, we need to zoom in on a very specific part of these reforms now, one that has huge implications for a lot of investors. If you hold shares on the alternative investment market, that's AIM, the next couple of minutes are absolutely critical for you. The treatment for AIM-listed shares isn't just a cap, it's a completely different and, frankly, much more restrictive set of rules. For years, AIM portfolios were a really popular tool for IHT planning because they qualified for that 100% BPR. Well, that is no longer the case. So here's the new reality for anyone invested in AIM. First, the relief rate is just chopped in half, from 100% down to a flat 50%. But here's the absolute kicker. AIM shares are completely excluded from that new £2.5 million allowance. That allowance is only for private businesses. This means for AIM shares, the 50% relief applies from the very first pound, effectively creating a 20% tax charge on your entire holding and making them way less attractive for this kind of planning. Okay, we've defined the problem, we've seen the financial hit, so now for the most important bit, what can you actually do about it? Let's walk through a strategic action plan.
Right, here is a clear 4-step framework. First up, you can't plan without the numbers. So get a proper professional valuation to figure out your potential tax exposure. Second, look at how the business is owned. For couples, rebalancing ownership could mean you can use a combined £5 million allowance. That's huge. Third, you've got to plan for liquidity. That £500,000 tax bill in our example has to be paid from somewhere. Life insurance written in trust is a pretty common strategy here. And finally, step 4. Update your will. An outdated will could now be really tax inefficient and might not do what you want it to under these new rules.
And this is really the key takeaway for taking action. These changes cut across valuations, tax law, and financial planning. A rushed fix close to the deadline is never a good idea. A proper, coordinated conversation with your accountant, your solicitor, and your financial planner is absolutely the best way to get a solid strategy in place.
So let's just recap the crucial points. The new world of BPR is defined by that £2.5 million cap, which can be combined to $5 million for couples. Anything over that only gets 50% relief. Remember, AIM shares are that special, harsher case, with only 50% relief on their entire value. The bottom line, if your business is worth more than £2.5 million, you simply cannot afford to ignore these changes.
And of course, we must include a disclaimer. This information is for general guidance only. Tax is incredibly complex and depends entirely on your personal circumstances, and the rules can always change. This is definitely not a substitute for professional advice that's tailored to your specific situation. To get that tailored advice, you can get in touch with the experts at Pro Tax Accountant. Their team can help you navigate all these changes and build a strategy that really protects your business legacy. The contact details are on the screen now for you. The phone number is 07985689912, and the email is info@protaxaccountant.co.uk.
So we'll leave you with this final thought. The rules of the game have genuinely changed for good. The only question is your succession plan ready for this new reality? For more crucial updates for UK business owners, make sure you subscribe to the Pro Tax Accountant channel. Thanks for joining us.